Hi everyone, thanks so much for joining. It is our first Friday market live for a good few months, in fact, because of the government shutdown last year. Non-farm payrolls, lots of economic data from the US was delayed, but this is the first time that it's all back to normal. So let's dive straight in. Let's see what we're going to expect from today's massive data report. And make no mistake, this is by far the biggest data report of 2026 so far. Change in non-farm payrolls, it's expected to be 70k. It was 64k last time. If you read our note earlier this morning, so our NFP preview, we said very crudely that anything above about 85k would be seen as hawkish and a strong labour market. Anything below 50 would be seen as weak. And both of those have big ramifications for financial markets, albeit in opposite directions. But the other thing we're going to be looking at is the unemployment rate. Now, if you follow my pointer here, the unemployment rate is expected to drop to 4.5% from 4.6%. Now, that doesn't seem like a big drop, and it's very technical in nature. It's largely down to the furloughed workers from the government shutdown coming back to their jobs, essentially. So that increase that we saw in November to 4.6% in the unemployment rate was seen as being a bit false, really, a bit of a false flag. A lot of people saw through that, including the Federal Reserve, who went on to cut interest rates, of course, in December. But the risk is that the labour market is actually much stronger than that. And if we see the unemployment rate fall to the 4.4% mark, then I think that will really set minds towards the fact that the US labour market is very, very resilient, the US economy is resilient, and that maybe the Fed made a policy mistake by cutting interest rates by 3 times since September, and maybe that is too much. Now, the market reaction to that, in my view, would be a recalibration of interest rate expectations. Currently, the federal funds futures market expects 2 rate cuts from the Federal Reserve. The other thing that we could see is strength in gold, because if the Fed has made a policy mistake and has loosened policy too quickly, too fast, too quickly, then that could trigger inflation down the line. And remember, gold is your ultimate inflation hedge. And then the second thing is we could see a stronger dollar. The dollar is already strengthening actually into this report, and we could see weaker stocks. The good news is bad news theme could come back to markets. Now, we're also looking, of course, average hourly earnings. The market's expecting a little uptick to 3.6%. I don't think that's going to have a big impact on markets. I think it's going to be the change in non-farm payrolls, any revisions, and what the unemployment rate is doing. But before we get this data, let's take a quick look at the dollar. The dollar is the strongest currency in the G10 FX base today. It's been one of the strongest since the start of the year, really having a bit of a resurgence. And if you take a look to the right hand side of this chart where I'm using my pointer here, we've made some big milestones. Now, the daily increases in the dollar might be quite small, but we have cut through the 100-day, the 200-day moving average, and we're currently testing the 50-day moving average at 99, currently trading at 99.03. So if we do get that stronger payrolls report, and there are some whispers in the market that it will be strong, then we could go back to that 100 level, maybe even to those highs from late November, just around 150. But I think it would be a big turning point for the dollar and could actually solidify dollar gains for the next few months, maybe even for the next quarter. The one thing I would say about payrolls has always been this way. Payrolls really does determine the direction of the dollar for the month, essentially. So we could see quite a big movement. Now, as we move into this, I will go back to the data in a moment. We obviously don't want to miss it. We're seeing the gold price has been a bit weak today. It has fallen quite sharply, but it is making up some of those losses. Oil is higher. And stocks, they're doing really, really well. So we've seen gains across the board in Europe. FTSE's a bit of a lagger, but look at the Euro stocks up more than 1%. But if we look as well at the futures market, yeah, US futures also higher if you just follow my pointer hit there, because of course, US markets aren't actually open yet. So if I just pull up that chart and then we'll go back and we'll talk a little bit more about that data. I think the point to note is that we're not expecting as much noise as we have seen in the payrolls in recent months caused by that government shutdown. So this should be a bit of a cleaner reading, but obviously there's still a bit of an impact of the government shutdown, particularly in the unemployment rate. So let's take a look. Let's keep going. What are we doing? Another 5 seconds. Oh, the tension is building. Let's see what's going on. Here we go. Oh, 50. So much weaker than expected, and a downward revision for September, for November, 56 down from 60, down from 64k in November. Oh, this is a tricky one. Unemployment rate, yes, it did. It fell to 4.4%, as I mentioned just now. Wages, though, higher. This is a really mixed report, guys. If we take a look, private sector payrolls were weak, 37k versus 75k expected. Also a downward revision there for November as well, 50k down from 69k. Manufacturing payrolls negative. Again, they have been negative for a very long time, not really expected. And actually, if we look at the 3-month average, that has got some noise in it, but that's 22k. So a weaker payrolls report. That supports what the Fed has been doing. And we should see some dollar weakness right now on the back of this. Let's just have a look at the chart. Sorry, it's just taking a little while to take up. See, it's backed off from its highs. So it's backed away from that 99.05 level, but it's taking its time to move lower, but I think it will move lower. I think it will go down potentially to the lows of the day. So about that 98.95 level, maybe 98.90. If we can stay above that level, that does suggest that, you know, demand for the dollar is very, very strong. Let's also take a quick look at the 10-year yield. I would expect that to be weakening as well, because this very much supports the doves argument at the Federal Reserve. Sorry, this is just a little bit slow coming up. That's because loads of people are using their Bloomberg terminals. Right, let's come back to that. And we will see what's going on. Yeah, so as you can see, yeah, the dollar is giving back its losses. Gold is giving back its losses as well. So gold is pretty stable at the moment. This doesn't really boost the gold price in our view, because it suggests that what the Federal Reserve done was right, and that the labour market is quite weak. And we're going to have to look a little bit more into the data, as you always do with this. Don't ever just accept the first reading or what someone says eventually. We did see a bit of a rally in that in the futures market in the US. That's to be expected as well, because this is good news for stocks. So a weaker reading suggests that the Federal Reserve has room to cut rates by more than the 2 rates expected. If we just bring up our interest rate probability chart, which is a super useful one. What are we seeing at the moment? So at the moment, yeah, so we're looking at potentially a cut in March of this year. Currently looking at kind of just under 2.5 cuts for the rest of the year, but I think that will move. This will take a couple of minutes, it always does. But if we just look at where we were for September rates, for June, we were expecting just over 1 rate cut. So rates pushing down to 2 rate cuts, or just under 2, rates pushing down to kind of the 3.35% mark. We needed to go down to 3.25 if we were to expect 2 rate cuts by June, and further cuts again in the second half of the year. But if we just look at what that was 3.35. So just earlier this week, just on Tuesday, if we look at where we were for June, we were about 3.31. So haven't seen a massive move yet, because this is very unusual data. There's something for everyone in this data. We've got the weaker non-farm payrolls, but we have got that strength in hourly earnings. Now that could be because it's December. Maybe there was a bit of Christmas bonus going on. And also people hiring to cover seasonal work, festive work. The drop in the unemployment rate as well counterbalances the weakness in the payrolls. But if we're going to say, well, actually payrolls is quite a forward-looking indicator, the unemployment rate is quite a lagging indicator and could be noisy because of what's gone on with the government shutdown, then it suggests this is a slightly weaker than expected report. Stocks can't make up their mind. Let's see if the dollar has moved in any way. Again, the dollar hasn't massively moved either, because it's really being kept in balance by the weaker payrolls number, but we've also got the drop in the unemployment rate, which is kind of bullish for the move. And look at this, just absolute whipsaw in the interest rate market, in the bond market. So that's the 10-year yield. If we look at the 2-year yield as well, sorry, bear with me. If we just look at the 2-year yield as well, I'm expecting something similar. Yeah, exactly. So it shot up to start with because it looked at that drop in the unemployment rate, and now it's come back down. So a lot of whipsaw price action. If you are trading this, do be careful, because there is a lot going on. I do want to just dig a little bit deeper into that payrolls number, which we can do here. Let's just wait for this to come up. This will be a really interesting chart. It will just tell us where were their job gains, where was their job weakness. So it looks like, yeah, there was weakness in construction, professional and business services as well, which we know has been seeing a little bit of a decline, and also trade, transport and utilities. So typically when you see weakness in the transportation sector, that is a sign of economic weakness. Now, the fact that this was in December, it could be impacted by weather. We know that there were big storms across the northeast. But government is still hiring, which it hasn't done for a while. We've got leisure and hospitality, which has been a big driver of growth. That's still driving job growth, up 47,000 jobs. Education and health services, that's also been a big driver. So these are still driving labour market growth. And actually, if you strip them out, it'd be a much weaker report. But of course, we can't, because it's, these jobs, these sectors are absolutely huge for the US labour market. So leisure and hospitality and education are still driving the gains in the labour market. But right now, they're not really able to kind of mask weakness elsewhere, not as good as they have been in the past, as we see weakness in construction, in manufacturing, and now in trade and transport. Now, I do wonder if there's a bit of a weather effect in the trade and transport and also in the construction sector. Remember, this is December data. We know there's been really cold spells as well in January. So this could take a little bit of a while to come out of the system. The government did increase jobs last month, not by much, to be honest. But yeah, the weakness is there. But the fact that the education and leisure and hospitality sectors are still creating jobs is probably good news, because they have largely been the sectors that have been creating the jobs for most of the past year. But it does look like a fairly weak report in my initial reading of this, because there's just so much weakness in the other sectors. So it's now really reliant on education and leisure and hospitality, whereas I would like to see broader job growth. That would be a sign of a more healthy labour market. But I think this is going to worry the Fed. It seems like the doves have control at the Federal Reserve. If we just go back to that world interest rate probability, because it does take a while to feed through, we're not really seeing too much difference at the moment. It may take just a little while. But we may, they've got their first meeting on the 28th. So there's basically no chance for a rate cut. There's only an 11% chance of a cut, with a 30% cut in March. I think March is more likely, because they may want to let things settle after cutting rates 3 times in the last few months of 2025. But I think a rate cut is coming in the first quarter. Whether or not it's going to be in January or whether or not it's going to be in March, we'll have to see. Again, it's just such a hard one to read, because everything is, look, this is back at the dollar index. It's not really moving. If we just take a look at interest rate futures, not really moving. Unwilling to give up highs though, because I think there'll be some in here, some sense that this data it has been affected by other factors. So not the government shutdown this time, but maybe weather, because there have been some other really good news. So the layoffs rate and the slowed in December. We also saw a pickup, really strong pickup actually, in the ISM manufacturing, in the ISM services employment report. That rose to its highest level since February last year. So a very mixed bag of data here. Very hard to know how the market will react. And in fact, the market is just staying still, which is typically what happens. If we just take a look at world equity indices, I mean, look, European stocks holding on to their gains, because obviously, both sides of this coin could be good for Europe. In the one side, if we had a strong labour market, then economic strength is good. On the other hand, Fed rate cuts are also good. So I expect to see down the line a little bit more expectation of a cut at some stage in the first quarter. So either the January meeting or in the March meeting, which is the 18th of March, or I would actually expect, I think it could be fairly mild, still undecided. And we just now need to wait for Fed speakers, maybe get the CPI data as well. But I see it as being quite a weak labour market report. Certainly jobs growth is not strong in the US. And I think there is continuation of current trends. But thank you all so much for joining. This has been always one of my favourite market lives, because I love looking at the data and the market reaction. immediately. This has not been necessarily the most clear-cut report, but we are going to get a little bit of noise. January and February do tend to be typical, so getting the December and the January reports can also be impacted by weather-related impacts. But thank you so much for joining, continuing to follow our analysis, follow us on YouTube, and also at Instagram and TikTok at XTB UK. Thank you.